Euro to US dollar is coiling at 1.1525 and the next move could be explosive. I've seen this exact divergence 3 times in my career. Twice it led to a violent reversal, once it didn't. The 1.1570 resistance and 1.1487 support are the levels you need to watch. Break above and we target 1.1622. Break below and 1.1345 comes into play. Full breakdown with exact entries, stops, and profit targets in today's video. ADP numbers drop tomorrow. The trade is already on my screen. Look at the options flow on Euro to US dollar right now. Open interest at the 1.1550 call strike just surged 40% in the last 4 hours. Retail sentiment is screaming long at 78% bullish. And that is exactly what makes me nervous. This is the Alpha Market Meridian, and I'm the founder. You're not getting a news recap here. You're getting the perspective of someone who's been trading institutional FX for over 20 years, and I'm telling you right now, the positioning picture on the euro is setting up one of those classic trap trades that separates disciplined traders from the ones who get their accounts blown up. Here's the setup. Euro to US dollar is sitting at 1.1525 as of August 5, 2026. The pair is consolidating in this tight horizontal channel between 1.1500 and 1.1555. And the market is effectively waiting for a catalyst. The problem is, when everyone is positioned on the same side, these consolidation breaks tend to be violent, and they often go in the opposite direction of what the crowd expects. What stands out to me is not the headline GDP numbers or the Fed vote, but the options positioning at the 1.1550 and 1.1487 strikes. That's where the institutional money has their gamma walls deployed. And when you couple that with the fact that retail is 78% net long on this pair, you have the ingredients for either a massive breakout rally as the short scramble, or a sudden liquidation that sends the euro plunging back toward the 1.1300 handle. Over the next few minutes, I'm going to show you exactly what I'm watching, where my levels are, and how I'm approaching both the scalping opportunities on the M1 to M5 timeframes and the bigger swing trade on the H1 to H4 charts. I'll break down the ADP employment report and ISM services PMI that are landing tomorrow, explain why the joint US-Japan intervention is distorting the dollar's behavior, and give you my proprietary read on where the smart money is actually positioned. By the end of this video, you'll have a complete trading plan with exact entry triggers, stop-loss levels, and take profit targets. And if you're trading this pair, you need to understand that the next 48 hours are absolutely critical. The decision point is here. The 1.1570 resistance and the 1.1487 support are the lines in the sand. And how this pair responds to those levels is going to tell us the entire story for the next few weeks. Here's my verdict. Euro to US dollar is neutral bullish with a bias that leans toward the upside, but with a very clear invalidation level that changes everything. I am looking to buy any flush into the 1.1487 support zone, but I am not chasing rallies above 1.1555 without a confirmed breakout. The pair has gained 0.7% over the past month, rebounding from those July cycle lows near 1.1366. But the momentum is clearly stalling, and we are seeing a corrective structure forming on the 4-hour chart. The invalidation for my bullish thesis is simple. A clean 4-hour close below 1.1487 completely changes the narrative and opens the door to 1.1345. If we see that level break, the bullish case is dead, and I am looking to get short. But until that happens, I am treating this as a consolidation within a broader uptrend, and I am looking for long entries on dips. Now before I get into the technicals, I need to hit the macro calendar because tomorrow is absolutely stacked with market-moving data, and the algorithmic reaction to these numbers is going to dictate the next move. Now coming to fundamental driver and calendar, structural emphasis. News first. Let's start with the macro picture because this is where the real story is unfolding. The Federal Reserve held rates flat at 3.5% to 3.75% in a deeply divided 9-3 vote. That split within the Fed tells you everything you need to know about the internal disagreements regarding inflation persistence and economic resilience. 3 dissenters wanted further hikes. That's significant. It suggests the central bank is far from unified on the policy path forward. Meanwhile, The Eurozone surprised everyone with a 0.4% quarter-over-quarter GDP expansion. The European economy is showing resistance to recession deeper than almost anyone expected. And this provides the European Central Bank with political room to maneuver that the market hasn't fully priced in yet. We are seeing a divergence narrative that is favorable to the euro on a relative basis. But here's where it gets complicated. The US dollar is being artificially weakened by massive joint currency interventions from Washington and Tokyo to support the Japanese yen. And this is something I've seen before. Central bank intervention distorts price discovery and creates false signals. The dollar is being pressured by these capital flows rather than genuine economic fundamentals. And that means the euro strength might not be as sustainable as the headlines suggest. I want to be crystal clear about what I'm watching tomorrow. The ADP National Employment Report drops at 8:15 a.m. Eastern, and this is the premier private payroll gauge that sets the tone for Friday's NFP data. The market expectation is for around 175,000 new private sector jobs, but the whisper number is pointing to around 190,000. If we get a print above 200,000, expect the dollar to strengthen as bond yields rise and Fed hawks become more vocal. If we get a miss below 150,000, the dollar sell-off could accelerate, pushing euro to US dollar toward that 1.1570 resistance. Following that, the ISM Services PMI at 10 a.m. Eastern is arguably even more important. The market is looking for 51.5, but the prices paid and employment subcomponents are what the algos are actually going to trade. If the prices paid index rises above 60, that signals persistent services inflation, and the dollar could rally despite the intervention pressure. If employment falls below 50, it suggests the labor market is cooling faster than expected, and the euro could spike higher. Eurozone retail sales month-over-month is also on the calendar, and while it's a secondary data point, it's a reflection of consumer inflation resilience. The expectation is for 0.2%, and any upside surprise above 0.5% would reinforce the Eurozone economic resilience narrative. So this is the fundamental landscape. We have central bank divergence that favors the euro, intervention effects that are distorting the dollar, and a calendar packed with data that could either confirm or invalidate the current price structure. Now let's get into the charts because this is where the level I really care about comes into focus, starting with the monthly chart. The euro is up 0.7% over the past month, and we are in a bullish corrective phase after that 1.1366 low in July. The monthly candle shows a clear rejection of lower levels, but we have not yet broken the structural resistance near 1.1600. This is a recovery rally, not a confirmed breakout trend yet. The moving average picture on the monthly time frame shows price above the 10-month EMA, which is supportive, but the MACD is still in negative territory, suggesting underlying bearish momentum hasn't completely faded. Moving to the weekly chart, I'm seeing a bullish bias. The pair is rallying this week as global selling pressure continues to burden the greenback. We have a series of higher lows forming, and price is consolidating above the 50-week moving average. What I'm watching is the weekly close relative to 1.1550. If we close the week above that level, it's a significant bullish signal. If we close below 1.1487, we have a bearish weekly reversal. Now the daily chart is where the real decision is happening. The pair is trading at 1.1525, sitting above the 20-day moving average at 1.1495 and the 50-day at 1.1465. Price is also above the 100-day at 1.1510, which is a critical level, but we are actually below the 200-day at 1.1527. That's worth highlighting. The daily close relative to the 200-day MA is going to be a key tell. The RSI is at 52.40, neutral but holding above 50. The MACD shows a bullish structure with the signal line at 0.0008, but the histogram at -0.0002 is losing immediate upward velocity. This is a consolidation phase, not a trending phase. The ADX is only 21.30, confirming that the daily directional trend is weak to moderate. This is congestion, plain and simple. And congestion zones are where traders get impatient and make mistakes. The CCI is at 14.50, hovering around the zero mark, signaling equilibrium. and the stochastic oscillator at 74.1% K and 78.4% D is pointing to slight overbought conditions, which would normally favor a near-term pullback. On the 4-hour chart, I'm seeing a short-term bearish corrective structure forming. Price is near the upper Bollinger Band ceiling, and we are getting minor bearish divergence on the RSI. This suggests we could see a pullback before the next leg higher. The 1-hour chart shows a neutral range-bound market. Price is trading within a compressed horizontal channel above 1.1500. The moving averages are essentially flat, and the volatility compression is evident in the Bollinger Band's narrowing. This is a market that is coiling, and the breakout from this range is going to be significant. The key levels I'm staring at a support at 1.1500, which is the psychological floor, 1.1487, which is the structural daily demand zone, and 1.1440 as the deeper support. Resistance sits at 1.1555, 1.1570, and 1.1622. The daily pivot point is at 1.1518, which is essentially the equilibrium level. The ATR of 0.0058 or 58 pips is the average daily range, so we can expect intraday moves of roughly that magnitude. I've seen this exact divergence 3 times in my career. Twice it led to a violent reversal, once it didn't. The difference was whether the fundamental catalyst aligned with the technical break. If the ADP and ISM data both come in soft, we break 1.1570. If the data is strong, we reject and sell off to 1.1487 or lower. The tell is going to be the reaction at those key levels, not the data itself. Now let's get into the exact trade plans I'm executing. I'm going to give you 2 scalping strategies for the M1 to M5 charts and 1 swing trading strategy for the H1 to H4 chart. These are real levels I'm watching, not theoretical analysis. Scalping setup 1. Long SCALP. This is the liquidity flush play. I want to enter buy positions on a rapid sell-off into the 1.1485 to 1.1500 support block. Here's why. When the market is in consolidation, institutions will often stop out weak longs and then reverse direction. If we see a sharp move down that breaks the psychological 1.1500 level but holds above 1.1487, I'm looking for confirmation on the M1 or M5 charts. The confirmation I need is a bullish engulfing candlestick pattern paired with the RSI recovering from oversold conditions, meaning below 30. This tells me the selling pressure is exhausted and the smart money is stepping in, and MY stop loss will be at 1.1470, placed safely below the local structural floor. That gives me about 15 to 20 pips of risk, which is appropriate for a scalp. My take profit is set at 1.1525, which is the current spot price equilibrium, and then 1.1545 for a partial exit. This trade has about a 1 to 2.5 risk-to-reward ratio, which is acceptable for a high probability scalp. But I want to emphasize, I'm only taking this trade if I see that precise liquidity flush into support. I'm not chasing price higher. Scalping setup 2. Short SCLP. On the flip side, I want to enter sell positions on an exhaustive test of overhead resistance between 1.1555 and 1.1570. This is the multi-day local swing high ceiling, and it's likely to attract a lot of sell orders. The confirmation I need here is clear price rejection wicks at the level, meaning long upper shadows on the M1 or M5 candles, paired with a bearish stochastic oscillator crossover in the overbought zone, above 80. This tells me the buying pressure is exhausted and sellers are stepping in, and MY stop loss will be at 1.1585, placed above the recent multi-day structural high. That gives me about 15 to 25 pips of risk. My take profit is at 1.1520 and 1.1500, which are the lower end of the consolidation range. The RR on this is roughly 1 to 1.5 to 1 to 2, which is solid for a scalp. But again, I'm only taking this if I see that precise rejection pattern at resistance. If price breaks above 1.1570 cleanly, this setup is invalidated, and I'm looking to get long instead. Here's the thing about scalping. I've been trading long enough to know that the key to profitability in these setups is not the entry, it's the discipline in taking the profit. If you get greedy and hold for bigger moves, the market will often come back and take your stop out. I always take at least partial profits at the first target. Swing trading setup, this is the big one. This is where the real money is made if we get the breakout. The breakout bull scenario, my trigger is a clean 4-hour candlestick close distinctly above 1.1570. This confirms that the consolidation phase is over and the bulls have taken control. I want to see the candle close above the level, not just a wick above it. A wick is a rejection. A close is a conquest. My execution is to buy on the first corrective retest of the broken 1.1570 level as new support. This is classic supply and demand trading. Old resistance becomes new support. I want to wait for the breakout, let the market pull back, and enter on that pullback. My stop loss is at 1.1530, positioned back below the daily pivot cluster. This gives me about 40 pips of risk. My take profit is at 1.1622, which is the major weekly structural technical resistance target. The EUR on this is approximately 1 to 1.3, which is decent for a swing trade. If we get further momentum, I would hold a partial position for a move to 1.1700. The breakdown bear scenario, my trigger is a clean 4-hour candlestick close cleanly below 1.1487. This validates a medium-term reversal pattern and tells me the bullish structure has failed. My execution is to sell short on a pullback to test 1.1487 from underneath. I want to see price come back up to test the broken support as new resistance, and then enter the short. My stop loss is at 1.1525, safely above the 200-period moving average floor. That gives me about 38 pips of risk. My take profit is at 1.1345, targeting the deeper structural monthly swing lows. The EUR on this is roughly 1 to 3.7, which is excellent for a swing trade. This is the setup I'm most interested in because the asymmetry is in my favor. I'm risking 38 pips to make 140 pips. That's almost a 1 to 4 risk to reward ratio. And if we get a clean breakdown, the momentum could accelerate. Now, before I wrap this up, I want to talk about risk management because this is where most traders fail. I've been doing this long enough to know that even the best analysis means nothing if you don't manage your risk properly. Let me share a personal experience. Back in 2018, I had a perfect red on a euro to US dollar setup. Everything was aligned: the technicals, the fundamentals, the positioning. I put on a sizable position and the trade went my way immediately. I was up about 80 pips and I got greedy. I didn't take profits. I moved my stop to break even and held for the bigger move. The market reversed overnight, stopped me out at break even, and then went on to make the move I had predicted. I was right on the analysis, but I managed the trade poorly and made zero money. That taught me a valuable lesson. Risk management isn't just about stop losses. It's about position sizing and mental discipline. For this euro to US dollar setup, here's my risk framework. First, I'm not risking more than 1 to 2% of my account on any single trade. For the scalp trades, I'm risking the small amount because the probability is higher. For the swing trades, I'm risking the larger amount because the risk to reward is better. Second, I'm scaling my entries. I'm not putting on the full position size at once. I'm building into the trade as the setup confirms. This allows me to average in and manage the risk more effectively. Third, I'm moving my stop to break even once the trade moves in my favor. This locks in the profit and eliminates the risk of the trade turning against me. I've seen too many traders give back their profits by not managing their stops. And fourth, I'm only taking the highest probability setups. I'm not trading every single move. I'm waiting for the specific triggers I described. The liquidity flush, the rejection at resistance, or the confirmed breakout. If I don't see those triggers, I'm sitting on my hands. The market is patient and so am I. There will always be another trade. The key is to survive long enough to take advantage of the big moves when they come. So let me summarize everything for you. EUR USD is at 1.1525. Consolidating in a tight range between 1.1487 support and 1.1570 resistance. The sentiment is extremely bullish, with retail positioning at 78% long. This creates the potential for a violent move in either direction. The key levels you absolutely need to watch are support at 1.1500 and 1.1487, and resistance at 1.1555 and 1.1570. A clean 4-hour close above 1.1570 targets 1.1622. A clean 4-hour close below 1.1487 targets 1.1345. Tomorrow's ADP employment report and ISM services PMI are the catalysts that could trigger these breaks. Expect significant volatility around these releases. My bias is neutral bullish as long as 1.1487 holds. I'm looking to buy the flush into support and sell the rejection at resistance. And I'm positioning for the swing break in the direction of the catalyst. I've been trading long enough to know that these consolidation zones are where the best risk-to-reward opportunities are found. The key is to be patient, wait for your trigger, and manage your risk. If you found this analysis valuable, make sure to hit that subscribe button and ring the bell. I'm releasing a full breakdown of the ADP report as soon as it drops, and I'll have a follow-up video on Sunday covering the weekly close and the setup for next week. Also, drop a comment below and let me know what you're watching on Euro to US dollar. Are you bullish or bearish? What level are you keying off? I personally read every comment and I'll be responding to the best ones in my next video. One last thing. The most important level for next week is the weekly close relative to 1.1550. If we close above that level, the bullish trend accelerates. If we close below 1.1487, we are looking at a deeper correction. I'll have a full breakdown of the weekly close on Sunday, so make sure you're subscribed to catch that.